one of the things that I have not really been big on is like crazy scenarios that lead to. I'm not really like a big conspiracy theorist or like the world's gonna burn kind of person. The markets just kind of ebb and flow. I like this flow that we've gotten over the past month and a half has been crazy. Even throughout this year has been nuts. So I want to kind of run through some things because definitely was paying attention to the student loan debt. There's some other things that kind of go along with it, and I think the stars and the holes align to where Q1, early Q2 of next year could be rather bearish. It can lead into probably the rest of the year. And I know some people have kind of hit it out. Yeah, you know what? Expect first half of next year, especially like a lot of market strategists have been saying, like, expect the first half of next year to be kind of choppy. And I don't think they really fully understand how choppy this is going to be. So follow along with me, and let me just quickly kind of go through this. So the reverse repo market. This is a market that's kind of managed by the New York Fed. And basically, this is kind of how the totals have been going over the past really 6 months. This is not not too long. All the way back to June, it was sitting at $2 trillion or over $2 trillion. And you can see now, like in November, we crossed under $1 trillion, and here in December, we are, rapidly, continuing to dwindle this balance. So, what the reverse repo market is all of the. Let me just Google this real quick. What is the reverse purchase agreement? A reverse purchase agreement or reverse repo is the sale of securities with agreement to repurchase them at a higher price at a specific future date. A reverse repo refers to the seller side of a repurchase agreement, RIP or RP, or repo. These transactions, which often occur between two banks, are essentially collateralized loans. The difference between the original price and the buyback price, along with the timing of the transaction, often overnight, equates to the interest paid by the seller to the buyer. The reverse repo is the final step in the repurchase agreement, closing the contract. Okay, so what's really kind of important to know here is the definition and really what they're used for. These are basically used for by banks with the Fed and the Treasury to kind of, hey, we don't have the capital to hold on our balance sheets, what we need to meet regulations, right? This is all about meeting regulations. So they go into this reverse repo. They say, hey, we need so much cash. Okay, we get the cash. The next day they kind of reverse out the transaction, and then they do this, and you can see here over the past 6 months it's been hugely in decline. Now, if you continue on at this decline rate, you get to maybe like February, March, April, depends kind of how aggressive it gets. Now, I'm gonna kind of pause there because it could get worse, and could get worse very quickly. Now, one of the things that we've heard of why the market and the economy has been so bullish and held up so well throughout this year is the American consumer. While the rest of the world is kind of like burning, like Europe, China, they're all kind of they're not really they're not making it through. Like they're all kind of hurting. The American consumer. This is an article from Axios, and basically I just needed the headline, so I just kind of, and there's plenty of articles, but what I want you to notice is October 17th, 2023, right? This is back in mid-October. Americans can't and won't stop spending in 2023. Well, that's interesting. Okay, so they won't stop spending, and that was back in October. All right, so that's kind of neat. So we go forward one more month, November 13th. Consumer spending falls in October, according to new CNBC NRF retail monitoring tracking card transactions. Okay, so the other part I was going to say to this, I really kind of wanted to find, like, there was some during some of these earnings calls, there were several earnings companies kind of saying that kind of closed, their books a little bit later than what the normal at the end of September was. And what several companies that kind of said was, we saw a pretty good drop there in October activity. So that was kind of interesting. It was kind of one of like, all right, what do you mean by you saw a significant drop? And that was just kind of all it was. It was just kind of like a bullet point. Some of these companies that kind of mentioned, and so it's kind of interesting. You go from October 17th, where the consumer won't stop spending, to November 13th, mid-November, the consumer spending fell. All right, so what kind of happened in October? Well, if you remember back a couple of months ago, the political parties were able to fight hard enough. I don't know, whatever you call it, but basically, the student loan delay or pause ended in October. Well, I guess it ended in October. You're supposed to start repaying in October. That aligns up with consumer spending falling in October, right? So check this out. Only 60% of student loan borrowers made payments when bills restarted. So fast forward another month, and now we can find out that only 60% paid in October, right? In October. So what coincided and what lined up in October with consumer spending falling was the student loan borrowers had to start repaying their loans. So, what is very interesting when you get into this is the 60% number. This is hugely bad. This is really bad. So, I'm going to go into a little bit of accounting. Accounting. Kill me now. But this is basically an account receivable cycle indicator or account receivable aging illustration. I don't even know where I got this from, some website. But anyways, I just needed the line. Don't worry about the line, like accuracy or whatever, but just understand we have dates, times of date, dates of service for delinquencies, basically, or people, how far behind they are on they're paying their obligations, paying their debts or whatever. So basically, most people are within that 30-day, right? Most people pay their bills, they're on time. This is typically like 80, 85%. Like, it's like people are paying their bills, maybe even higher. 60 days, right? That's within the first 30 days. You get your credit card statement every 30 days, you pay your bill. Okay. 60 days. This is the big one. 60 days. After 60 days, basically it no longer is, you failed to pay your first month. Okay, I mean, stuff happens. Wife goes to the hospital. Oh yeah, I mean, I totally forgot to pay. Something happens in the family, travel, credit. Your maybe you change banks and you forgot to change auto draft, whatever it is. Sometimes things happen, people slip past that first month, they fall into the second month. Okay, second month, you fall past that, it's big time. This starts to kind of hit your credit report. This kind of starts to get the agency, whoever holds the debt, whoever you're paying the debt to, they really start to look at you. They start to, hey, like, make calls. So who holds the debt and who are these people supposed to be paying the debt to, right? The 60%. Well, this is going to the Department of Education, right? Department of Education or the Treasury. I don't know who actually services the debt, but it's basically the federal government. So if you think that they are not going to be aggressively coming back and trying to get their money, they will. And one part that, if you don't know, is that they can seize your bank accounts and or take money straight out of your wages. So if it comes to that, and if you're having to live off of even less, that is where it will be very difficult for people to continue to spend money that they don't have. Okay, so I'm not going to go down that rabbit hole, but what you kind of want to know is usually within the first 30 days, typically like 80, 85%, and then it drops off. Most of the time, like with, in between 30 to 60, maybe like 10. And then after that's maybe like, the rest 5%, 60 to 120. And after that's like the rest. And it drops off quite substantial because most people are within that 30 days. Most people, 60%. Like, I get it. That's still most. I get that. But 60% is not what is normally this number. This number is normally like 85% or higher. And then 60 days, in between that 30 to 60 days, this is like 10%. So this is going to be rather interesting to see really what winds up being this number when we get that next batch of data. Because after that, then you can start to really kind of figure out what the slope of the line is. The first month, people haven't paid student loans in years. So you kind of got to give some benefit of the doubt. There, might have been some confusion how to play. I saw some articles like there was some confusion how to pay or whatever. Like, okay, so you got to give them a little bit of benefit of the doubt. So you want to see really how many people pay here in between that 30 to 60 wind up falling in that window. Because if there's a lot of people that don't pay and this drops off to like single digits percentage that pay between that 30 to 60 day window, this will be a big deal on how far behind they are, because then it is going to be that many less people paying down the line, because it's not going to uptick, right? It doesn't uptick the further down the line of delinquency you go. It's typically like you start writing it off. Businesses start writing it off, okay? So what are people living off of? Credit cards, right? This is the credit card tracker put out by the Fed. Okay, total U.S. consumer credit card balance sheets in the U.S. And one of the things that you can kind of see here, here's the beginning. Hold on, a little too far back. Here is the beginning of 2023 right here. Okay, so throughout 2022, beginning of 2023, halfway through the year, you can see it's actually kind of going up at a pretty linear line. Like that line's kind of falling off. Here since late summer, it's kind of dropped off, or it didn't continue up at the same pace. And then we had a little bit of a downtick there, and let me just zoom in to that last little bit there. So we had a little bit of a downtick here at the end of October, and this little spike up here, this is Black Friday, right? That Black Friday week, so you get a lot of credit card balances always that week. Like every year, you can go look at like November, that last week of November that year, and you always see like a nice little spike there. So we are starting to see a little bit of a sluggishness. And the other thing I would say is, if you're really hurting for money, or you're really hurting on cash, you're having to repay student loans. Well, what are you going to do for the holiday seasons? Well, you're going to still buy gifts, but you're going to go look for the best deals possible, which would coincide with that week, right? Black Friday week. So it's going to be interesting when these 60% of the student loan borrowers start having to repay, but it only winds up being like 70 to 80% are actually repaying. And we're not going to really know that here for like another month or two, which is why I'm saying like February, March, gonna be kind of interesting when we get to some of these kind of data points. Because if people are just living by on credit, and they get down the line, and then these banks start to say, hey, yeah, you know what, you can't continue to live off credit, we're going to lower your credit limits, then what are people going to do? And this is where you look at housing. What are the things that you want to pay for every day? Well, start the highest level. You want to pay for food, right? You got to pay for food because you got to live. After that, you're probably going to look to, if you got kids, you're going to take care of the kids. So those would be like 1A, 1B. And then after that, it's probably going to be your housing situation. Like that's the next bill you want to pay. And three of the biggest reasons why people aren't selling their homes. And this was from EAP, I believe Easy Agent Pro. Not really a big deal. I didn't really care to find this, but there's three reasons. This is like the one reason. Rate concerns. A big reason why rate concerns is because you can't go buy a new house at a higher interest rate than the one you have, right? If you locked in and got a house at like 4% and now interest rates are like 6, 7%, even though they've come down over the past month and a half, that is still a huge, huge difference between what you got. Okay. So all of that kind of being said, so all of that together, this is where I think the reverse repo market kind of comes into head and drops off and gets to like that zero line about that same time out in like February, March, the same time these delinquencies on these student loans, right? And once you get out there where those credit companies are going to start to feel it, and where is the consumer not going to spend is going to be the big deal when we get to February and March. That will be the one area of concern that I would have around that time period. And this is one that could probably continue to snowball throughout the year, right? If people are paying their life, a lot of their livelihoods based on credit card balances, and their credit card balances continue to go higher, which normally during recessions, credit card balances do continue to go higher. This number does continue to go higher through like the recessionary time period, and then after the recessionary time period, you do usually get this drop off. Even back in, if you look at this data back in like 08 or whatnot, it'll look that way as well. So yeah, looking at 08, you see it kind of continues to go higher through this recession back into early 2009, and then it drops off even back in 2001. In that bear market, it kind of just stayed at least somewhat steady. It didn't really drop off all that much. So the point is, when we get to the end of Q1, beginning of Q2, that is where you're going to see a lot of these credit card companies start to change maybe credit limits, credit scores, and that kind of stuff. And people might not be able to live on credit as much anymore. And then that can spill over into the housing market. Because when you cannot pay your bills and you can't continue to live off of credit cards, one of the things you're going to have to do is probably look to sell your home. And that will probably be pretty tough, because I'd imagine a lot of people would not be able to get, maybe, I mean, at first you're probably going to be able to get, your equity out of it. After that, you might not be able to get your equity back out of it. And that's the part of, snowballing into a housing issue that would probably happen next year. I would imagine this probably does happen next year. So we'll see what happens, but this would all align kind of with credit card companies, also, reverse repo kind of dropping off and getting down to that zero level. And if banks can't use the reverse repo market anymore to fund its capital, then it's going to start to really be strict. A lot of these banks will probably really tighten up their hold on how much credit they're allowing out there. They're going to be holding on to capital any way that they can. So that's just kind of one of the things I wanted to kind of go through. I think those two things, the reverse repo market and the 60% of student loan borrowers is, only making payments. I think the student loan part of it is hugely slept on, hasn't really been talked about as much. And this is something that is really kind of, I think, is really going to start to hurt the economy because they're not going to spend money. They don't have the money to spend it, especially if you got to repay student loan bills. So something's kind of got to give. And I think taking all this capital out of the economy is probably going to be the one that winds up doing it. It doesn't happen right away because the contracting forces are the financial system, and this is where we will see those contracting forces in February, in March, and probably see it continue to percolate throughout the year, especially if people aren't going out to spend money, then people are going to get laid off, which then that kind of just it keeps the domino kind of going, right? It keeps that domino going. Like people don't have any money to spend, so they're not going out to spend. We just saw that with the report from October. People are spending less, and now that people are spending less, well, layoffs will probably happen, or people won't be hiring. Therefore, people won't go spend more money because they'll be getting laid off, and so it just snowballs. It'll be a snowball that'll probably start to happen, I would imagine, in February. So that's just kind of all I want to say about that.